at Axis Securities. Mr. Vaidya, great having, apologies, Ms. Vaidya, great having you. Ms. Vaidya, talk to us about this perspective of HDFC Bank in particular. Realistic to bring down loan to deposit to 90% at all by FY27, given the kind of growth trajectory that they're looking to pencil in? Can they do that at all?
Right. Hi, good morning.
Very good morning.
So yes, the about 90% odd of LDR by FY27 may be possible, though it looks difficult because if loan growth is 200 basis points higher than systemic growth, so that's pegging it loan growth to about 15 odd percent for FY27. Deposit growth will need to be at least 400 to 500 basis points higher than credit growth. Of course, the bank has levers to accelerate deposit mobilization, but our estimates suggest that for HDFC, the LDR by FY27 could stabilize somewhere between about 91, 92 odd percent. Yeah.
Yeah, if you look at HDFC Bank and they're looking at the LDR coming down to 90%, which basically means they're looking at an aggressive deposit growth in FY27. Do you think that that's possible in this scenario?
Slightly difficult, yes, but about 18. If we take about an 18% of growth, now that would come from aggressive CASA mobilization, leveraging their branch network, because the management has highlighted that branches that mature over 5+ years of vintage generally have the ability to garner roughly 3x more deposits. So they have a fair enough chunk that moves into the 5-year plus vintage, that so they could leverage that branch network. Also deepening relationships, so the mortgage and the credit card portfolios that the bank has, that is mainly for that mainly helps in deposit accretion. So leveraging that, the bank could accelerate it, but yes, going back to the pre-merger levels of LDR in the current scenario looks a little difficult. So pre-merger would be somewhere between 87, 88. Early 90% is what we are looking at for FY27. Yeah.
Okay. And Ms. Vaidya, your take with regard to the one-offs that HDFC Bank did in terms of adjustments to ensure that that 1.92% ROA was clocked. Do you believe that that was in some form or shape managed, or do you believe that that was largely fair and this is something that they will be able to continue to clock going forward as well?
Yeah, so the 8 billion one-off that they had in the earnings, that was a little bit of a surprise. It was on the higher side, and the management has also clarified that these are on the higher side when it comes to estimates, given the data that was available. The 5 billion one-off provision that the bank had to take for the PSL compliant agri loans, credit costs were more or less stable, because slippages have also been, barring the seasonal agri slippages, they've been fairly under control, and it's been a benign credit cost environment when it comes to, especially for HDFC Bank. So it's 1.8 to 1.9 is something that the bank has been delivering. A better performance of NIMs would have been better, but of course this quarter did surprise with the 8 basis points improvement in margins. Yeah.
Perfect. Okay, Ms. Vaidya, I want to shift towards ICICI Bank, and a lot of the action this weekend at least has been ICICI Bank, because they've consistently or gotten the street used to the fact that they'll do a 2.3 to 2.5% ROA. That hasn't happened this time around. They've had to take a knock of 1,280 odd crore. Now, what does that mean in your opinion? This is, of course, what they call a reclassification from PSL to non-PSL. They also suggested on the call that they will attempt to move this back to PSL, and if that were to happen, that there will be a reversal. But given past precedents, technically that rarely happens. Your take?
Yeah, so this was one of the major reasons why there was a large miss on the earnings estimates for ICICI Bank. However, if these loans they've been able to classify it as PSL loans, there would definitely be the provision reversal, which should then aid better credit costs. But barring this, we expect that the credit costs have been largely stable. Then we've not seen a problem. It's been in the range of 35, 36 odd basis points, and that's a steady state credit cost that the bank has been delivering.
Okay, so that's an ICICI Bank. But just talking about that bank a little bit more, the reappointment of MD and CEO, Mr. Sandeep Bakshi. Talk to us about how you're reading about this, because major turnaround in the bank's financials have been bought by him. How are you reading this? How do you think the street is going to react to this?
So yes, definitely the extension of term for the current MD was an overhang for the stock. Now with the appointment or reappointment for 2 years until October 28 will definitely be read as a positive for the bank, and that should help stock performance going ahead also. Apart from this, the bank will also be delivering a fairly healthy earnings growth that should also complement this re-rating of the stock.
Given the fact that the ROA and on the NIM side, HDFC is now lagging behind ICICI Bank. Do you think that there will be a valuation difference which will continue at least for a couple of more quarters before growth comes back to HDFC Bank?
So yes, definitely HDFC has, we've seen there's a gap in valuation, but we expect some narrowing of the valuation gap for HDFC and ICICI. What works for HDFC is that we should see margin improvement better than ICICI for HDFC Bank, and that should be led by an improving CASA mix, accelerating growth, and also lower cost of funds, given that the erstwhile HDFC borrowings mix should come down. So these were high cost deposits. We don't see any problem on the credit quality of either of these banks, but we expect some narrowing of gap in terms of valuations for both these. Yes.
Okay, Ms. Vaidya, if I can ask you, or if I can request you to wager a guess, HDFC Bank and ICICI Bank, we've seen a bit of a pullback with regard to the stock price of HDFC Bank a month to date, and I know you don't look at it short term, but if I were to try and guess as to how this plays out this morning, do you believe that there could be an uptick, given that HDFC Bank's numbers were largely in line versus what probably the street was penciling in as being slightly softer, or at least what they were expecting to be a slightly softer set of numbers, given the kind of pullback we saw on the stock price? And what about ICICI? Because that has also surprised a bit, but then the appointment of Mr. Bakshi kind of solidifies any concern that the street had. So what's your sense?
Right. So we've seen that the stock has corrected in the past month, especially post the provisional figures came out. So this, we believe that this is a good price to enter HDFC Bank. And given that it's been a largely inline set of numbers and no concerns over any of the key parameters for the bank, we expect to see a positive impact on the stock in today's trading session. When it comes to ICICI, yes, the credit cost did negatively surprise. However, as you mentioned, the MD's reappointment is a positive. So flat to mild positive could be seen in today's trading session for ICICI.
Excellent. Some of the mid and small cap banks also came out with numbers. Anything that stood out for you? Yes Bank's margins went up to 2.6, so that was possibly a positive. I saw good growth there as well. RBL was a bit of a mixed bag. How do you view some of those other numbers?
I'll not be able to comment on Yes and RBL. It's not
Sure.
under coverage, but for Federal that we cover,
Yes.
very good set of numbers. Actually, stellar performance this quarter. Margin surprised positively. Overall growth is coming back after the reorientation of the strategy. Most key parameters are falling into place how the management had envisaged that. So yes, we remain positive on Federal Bank as well. Improving ROA is something that we see, and we see a consistent improvement. So from 1.1% in FY26, we view a sharp improvement to 1.4% by FY28, largely driven by margin improvements and steady decline in overall OPEX ratios. That's what's leading this ROA improvement for the bank. And we have a buy on the stock.
Okay. And lastly, Ms. Vaidya, before we let you go, talk to us about your verdict on the overall banking earnings that we've seen so far. Have they been in line with your estimates, or slightly softer, or even better? And talk to us about the pecking order. What are you liking from this bank?
Right. So at the start of the quarter, we expected that the mid to smaller banks should outperform the larger banks when it comes to margins. And we've seen a similar performance. Of course, HDFC came in as a surprise, contrary to our expectations of flat margins during the quarter. Amongst the larger banks, we prefer Kotak and HDFC. Amongst the mid-sized banks, we like Federal, and amongst the small finance banks, we remain positive on Ujjivan.
Okay, thank you so much, Ms. Vaidya, for joining us this morning and giving us that perspective. It was quite a long chat, and thank you for taking